What's going on, everybody? It's Jamel Gibbs, your family-oriented entrepreneur. Welcome to the Deal Pro podcast. Today, we're going to talk about why more people are switching to First Lien HELOCs in 2025. So what if I told you there's a smarter way to pay off your house? Rather than waiting for 30 years, rather than refinancing, rather than working more hours in order to do it, what if you were able to pay off your house a lot quicker? We're talking about years in advance. That's exactly what my special guest and I, Anthony Rushing, are going to talk about on this podcast. Now, today we're diving into a powerful strategy. It's called First Lien HELOCs. And this is the strategy a lot of homeowners are using today to ditch their mortgage and pay off their house, again, years faster. If that was possible for you, how would that change your circumstances? How would that change your life? What would that do for you? And what type of opportunities would that present for you as well? We're going to break down what it is, how it works, who's it for, and how people just like you are using it to unlock cash right from their properties. They're crushing debt with this cash, and they're also gaining that financial control in order to be able to live the lives that they want to live. Again, for their families, they're doing it for their grandchildren, for their kids, whoever. You're doing this not for yourself. You're doing this for everybody around you. How can you take care of everybody else around you? This is where this tool comes into play. So if you're a homeowner, you're tired of high interest rates, or you're a real estate investor looking to unlock trapped equity. I read a quote the other day in my comment section. A guy said, you can't eat equity. So it's best to use that equity to build more wealth. That's the epitome of what we're talking about today. You can't eat equity. So what can you do with the equity? And how can you unlock that equity in order to be able to build the wealth that you want as a real estate investor? Again, I'm Jamel Gibbs. I'll be your host today. Special guest, Anthony Rushing. And we're going to talk about this in full detail, why people are switching to First Lien HELOCs in 2025. Anthony Rushing, what's going on, brother?
Nothing much, Jamel. I'm just excited to be here and be able to chat with you. I really appreciate you having me on today, and excited to talk.
Absolutely excited. Now, you've been on the channel before, but
Yeah,
for those of you who don't know Anthony, why don't you go ahead and tell them a little bit about yourself, man?
yeah. Thank you. I'm the sales manager of our mortgage branch at First Savings Bank, where we specialize in helping people with first lien HELOCs. As a matter of fact, it's the only kind of home loan that we have. So I don't have a conventional home loan. All we have are first lien HELOCs, and we teach people how to use them, and we teach people how to aggressively pay off their homes, save a ton of money in interest costs, and like you said before as well, unlock equity for capital purposes as well to use for cash flowing investments, that kind of thing. So specialize in this, and really just I love the benefit that it can bring to people's lives, and so have dedicated my professional life to doing just that. So that's kind of me at this point in a nutshell, if that makes sense.
Nice, man. Now, what made you first start looking into First Lien HELOCs, and when you first found out about it?
So going back a little bit in my past, I didn't start in the financial sector. I started off in education. And right out of college, I joined this program called Teach for America, which is through AmeriCorps. And you volunteer for a 2-year time period. And they essentially supercharge you to become an extremely effective teacher and put you into high need schools. And the goal is that you are so effective that your kids outperform middle and high income kids from a growth standpoint to help them catch up. And that mission spoke to me as a person and what I want to accomplish for my life, because I knew that my work and my toil and blood and sweat, and there were some tears there too, was for helping people that deserved it. And helping people was the main thing. And so that really helped answer a calling, I think, that I have as a person. And stayed in the classroom 7 years. I got my master's in education leadership, was going to go the admin route. Then I had kids. I had twins, and we moved to Nashville and didn't know anyone. And finances became a little bit difficult for us. And so, and at that point, with two kids that were young and a new city and all that, I did get a little burned out with education, so decided to make a move, and wanted to do so in a way that I could support the family, in a way that wasn't as stressful as it was. And so I made a move to the mortgage industry. I had a friend uh, did who did traditional mortgages, and I entered that business and did it. I remember my best friend called before I made the move and said, "Hey, Anthony, that satisfaction you get from knowing that your work helps people." And I said, "Yeah, I do know that." And he was like, "You're not going to find that in the mortgage business. So you're going to have to look for it, and it might be really hard to find." And that was I'm glad he said that because it was true. I really had to try and find it because it's a very dog eat dog type business,
Mm-hmm.
very transactional, if that makes sense. And then through that, I met my current boss now, who introduced me to this concept of the first lien HELOC, which is this mortgage product I'd never heard of before. And um, and I learned what people are doing with it. And I also learned that no one else knows about this. So, and what it's able to do is it's really able to change people's futures when it's a good fit. And it drastically changed their futures, meaning paying off their home extremely quickly, 5, 6, 7, 10 years compared to 26, 30. And so the benefit that it brings to people is astronomical, and no one knows about it. So here I am entering into this new understanding that there's this product out there that A, not many people know about, and B, it can drastically change their life. I get to use my teaching ability, we'll call it, if I was good.
Mm-hmm.
Hopefully I still am, or hopefully I was. I get to use that skill set, but then I also get to answer the call that I have, which is do it in order to help improve people's lives. So I just I jumped head in, and I never looked back. And I'm so grateful that I learned about it. It's because now my work still gets to help people, and I get um, provide for the family in the way that I hope for as well. So it's a complete win-win, and it was a super super tight coincidence that I'm extremely grateful for. So that's how I found out about this, and the reason why I'm so passionate and excited about it, and just want to share it because for the right person, it can be amazing.
Absolutely, brother. Now, why do you think more homeowners are frustrated with traditional mortgages today?
Well, there are a couple of things with traditional mortgages that are just realities. One is that um, the amount of interest that you pay at the beginning of the mortgage for the first 14 years is substantially greater than the amount that you pay toward principal. So I did a little bit of math on a $300,000 home loan at 4.5% rate. On a 30-year fixed rate mortgage, you'll give the bank $64,000 in interest. However, you have only paid your home down by 26,000. That may not be something that people talk about all day,
Mm-hmm.
or that people talk about a whole lot. I think what they do is they kind of push that reality under the carpet. But the more that people come to the realization that the amortization schedule isn't built for their benefit, but it's built for the bank's benefit, people get really frustrated with that. This is the institutional mortgage that you're supposed to get that everyone believes is great. And we're walking around being proud that we have a low interest rate on paper, but we're giving the bank all the money. And so I think the more that people realize that, the more frustrated they get with it as well. And so that's one factor, not to mention the fact that every time that you refinance, you reset that clock. You go back to the beginning to giving the bank all the money. And um, so I think that's when I talk with people, those are the kind of things that are leading to this frustration. And then there's also just the reality that most people don't pay off their homes for the majority of their life because they keep refinancing.
Mm-hmm.
And so even the idea of paying off your home in 30 years, which is still a very long time to hold a loan, to owe somebody, um, people don't get out of debt until their very last mortgage. And so there's this idea of becoming debt free and paying off your home where the way that the amortized mortgage is set up, it's not set up for that to be a reality. So I think that's a lot of it, to be honest.
Got it, man. And that's a perfect segue into this next question I have for you, man. For somebody that's brand new, let's say they don't know what a HELOC is. What
Yep.
exactly is a HELOC, and how is it different from a regular HELOC or a mortgage?
Yep. So a HELOC is an open-ended line of credit, meaning money can go in and out freely. That's placed on the equity of the house. So the kind of HELOC that people are used to talking about is a second position HELOC, which when you get that, you keep your mortgage and then you just open up a line of credit on top of your mortgage, and you can access the equity in your home. That's a second lien HELOC. That's different than what we specialize in. What we specialize in and what we focus on is a first position HELOC, and that's different than a second in that it pays off your mortgage. It's a full refinance. So, for instance, if someone owed $200,000 on their house, and let's say it was worth 400, right? What our first lien HELOC would do is it would pay off the mortgage, and I could go to let's just say the line amount, the max line was 300,000. So that line amount, that HELOC, would have paid off the mortgage. So now it would have a balance of 200,000, but the limit would be 300,000. So what that would mean at that point is they'd have access to that additional 100,000. So that's how it's different than a second lien HELOC in that it just pays off the mortgage. It's different than an amortized mortgage in two main ways. One is that money can go in and out freely. With an amortized mortgage, you can pay it down as much as you want, but all the money that you put toward the mortgage is locked away. You can never take it back out. It's just how they work. With a first lien HELOC, money can go in and out freely. So the money flow is one where every dollar that you put toward paying down the balance, you can also take back out, which means that you can safely put as little, you can safely put as much. You can safely put everything toward paying down this house if you wanted to, because you can take it back out. So that's one main difference. The second has to do with how they calculate interest. So your amortized mortgage, what it does is it looks at the previous month's end balance, and it uses that end balance against your rate to calculate the payment. That's just how they do it. The right first lien HELOC, and the bank said it's very important for me to say the right first lien HELOC, because they said I can't actually know if everyone does this, but for this strategy, that the right one calculates interest not by looking at the previous month's end balance, but by looking at the average balance of that month. So it takes all the days, different balances. It takes an average of all those different days' balances, and it uses that average balance against your rate to calculate your payment. So those are the two main ways that it's different than a mortgage. But other than that, it's still a lien on the property. It's still considered a mortgage per the credit report. So it's still a mortgage product, but it just functions differently. It follows different rules than an amortized mortgage does. And so we just know what those rules are. So we teach people how to work within those rules.
Got it. And I'm glad you answered it that way, because obviously we've done content like this in the past where people may have commented, hey, I'd rather just pay my house down.
Yeah.
The difference between paying your house down, which you have every right to do, is the money is not available to you after you pay it
It's
down.
not available.
It's locked into your house. Whereas opposed to a HELOC, especially as an investor from an investment standpoint, or somebody who needs free cash flow,
Mm-hmm.
a HELOC provides just that for you. So you, just like a credit card, you pay it in, you can pull it back out. With a regular mortgage, you can't. And as far as another way that we explained it when it comes to the amortized interest and the HELOC style interest, HELOCs use simple interest, so it's like paying off a car.
Mm-hmm.
Right? It's very similar to having a car payment versus
the amortized interest that comes
interest. So you're going to pay
with a mortgage.
Exactly.
Yep.
Good stuff, man. So how does using a HELOC, a first lien HELOC, help someone to pay off their mortgage faster compared to a regular mortgage?
Yeah. So this really comes down to those differences, right? We know it calculates interest using the average daily principal balance, and we know money can go in and out freely. So if I think about the average balance of the month, I've got a bunch of balances that I need to take the average of. So if a lot of those balances are a little bit higher, it's going to result in a little bit of a higher average balance, higher interest payment. If all those days balances are a little bit lower, it's going to result in a little bit lower average balance, average payment. But if I want the lowest payment possible, I need to create the lowest average balance for that month, which means all those days need to be as low as possible. Well, we can control the balance here by basically deciding how much money we put into the HELOC and when. Mm-hmm. So if I want to create the most number of days with the lowest balance, I need to create the lowest balance now. I don't want to wait 5 days and have the balance be higher because that's a higher average balance. And I don't want to put a little bit of money in today because that would create a little bit of a lower balance that I'm paying interest on. I want to put all the money in today to create the lowest balance possible. So that's exactly that. That's the first part of the strategy is you just drive all the income into the first lien HELOC, not your checking account. You drive it to the first lien HELOC, and that pays the balance down as much as you possibly can. You're controlling your balance with everything you have to create the lowest balance possible. Well, now that all the money's in there, you got to pay your bills. So the great thing is here, remember, money can go in and out freely. So that's exactly what you do. You pull the money out to pay your bills. Well, that increases your balance. Mm-hmm. And so I think about 1 month cycle, all the money goes in creating the lowest balance possible. Then you pull from this to pay your bills, and that increases your balance. So if we think about a scenario, when this works, that means there's a lot more money going in than what's coming out, mm-hmm. which means there's more income in the household than there are expenses. So if you have a $10,000 decrease with your income and your expenses are $6,000, that means it goes down by 10, up by 6. That month, we would say you paid the home down by $4,000. That's the surplus. So it relies on there to be residual income. It relies on there to be surplus. It relies on there to be cash flow. And so the greater the cash flow, the more effective this strategy is to reducing debt and crushing your whole debt balance. For households that are really tight on their budget, if it goes down by 10 and goes up by 10, the balance doesn't change. So households that are tight on their budget or they're struggling month to month, this would not be something that would be of benefit to that household because it relies on there to be cash flow. But when people cash flow, when they make more than they spend, it can be amazing. So that's really the strategy. It's not hard. It's easy math. It's a subtraction problem and an addition problem every month. And so it's a simple way of leveraging everything you have and leveraging your disciplined lifestyle to achieve something that is absolutely amazing.
Yeah. And people, again, I love the fact that you mentioned discipline, lifestyle, because you need to be disciplined with this. You got to have cash flow. If you spend more money than you make, this won't work. Right. Yep. So there's a certain person that this is for.
Yep.
And that's the responsible person, the financially responsible person.
Yes.
Right? And you have to be making a certain amount of money. I read something today. It said, it was a video, like one of those skits. And he said, so the average rent is, let's say $2,500, and your job wants you to make 3 times that, which is about $7,500. Mm-hmm. I think it was more like $72,000 a year, right? So he said, how can we afford it if you're not making that much money? The point is you got to spend less, right? And you got to allocate your money the right way. Some people just don't make the money to be able to do something like this, right? Some people just don't have the cash flow because every dollar that they put in, they're pulling back out. But for the people who have cash flow, they have a decent paying job, they're living below their means, they're financially responsible, this is the perfect opportunity for somebody like that.
That's great.
So people love examples, man. Could you show us an example of how this will work?
I can. So I'll share my screen quickly and show you what we do here at First Savings Bank to figure out if this will be a good fit for someone or not. Let's see if I can share. Are we sharing here?
Yes.
Great. So this is one of the calculators we use. It's a mortgage versus HELOC calculator. The other one we use is just the HELOC side. But what we've got here is a comparison calculator that compares someone's current mortgage to if they were to switch to a first lien HELOC. So in this scenario, on the left side is our mortgage side. So we're starting with a $300,000 balance at this point, the rate is 4.5. For something else, I had it at 30, but we'll just say this person still has 26 years left on their amortized mortgage. Homeowners insurance is $100 and property taxes is $200 each month. So that's on the mortgage side of this calculator. And this is the input here. So then on the right side, we have the HELOC terms. And so we have the same 300,000. I'm using an interest rate of 8% on the First Lien HELOC. Right now, that's about where they sit. Our First Lien HELOC at First Savings Bank is a variable rate product, so it does change. Both the higher rate and the fact that it's a variable rate product can come with a lot of sticker shock and fear. And I'm totally fine with that. I understand. What I usually ask people to do is just bear with me for a little bit, because it is possible that even a higher interest rate home loan can be better. I know that is challenging to hear and accept. I can go more into that later on, but what I ask them is don't hang up quite yet, because I want to show you what's possible here. And so remember, this strategy involves driving in your income and then using it to pay your bills. So this is an example household that they bring in $12,000 a month and they spend $7,500. So their mortgage, this $7,500 total spend does not include their mortgage payment. So including about a $2,000 mortgage payment, which I'm assuming is about where they'd be, their total spend would actually be closer to $9,500. So including their mortgage. So minus their mortgage, their total spend is $7,500. Again, remember, this does work really, really well for people when they're disciplined and when they make more money than they spend. So that's sort of why I set this up this way. And the loan doesn't escrow. So I included a $1,200 annual insurance payment and a $2,400 annual property tax payment as well. So this is what we're comparing: a 26-year, 30-year fixed at 4.5% that's currently at $300,000 versus an 8% First Lien HELOC at $300,000 balance as well. So this then goes to the summary. And so, by the way, this is what we do with every single person that we work with. The most important question that we ask ourselves on these calls, we like to consider it more of a discovery call, but the first question we ask is, should the person get this at all? And then the question is, can they get it? And so the first thing that we focus on is this going to be a good fit for you before we ever talk about getting you into it? And if it's not a good fit, we will tell you. And if it is, then it may make sense for you to move forward. But all that being said, this is a good example of what can happen. So we've got a 26-year payoff for the current mortgage. And the total interest, the total remaining interest, this doesn't account for the 4 years of interest you've already given the bank. So the remaining interest that this mortgage would result in would be $209,468. If we compare that to the First Lien HELOC, with that budget, they'd pay off the home in 8 years, and they would give the bank a total interest of $107,264, saving over $100,000 in overall interest costs. Now, if you were to compare this cost against a $300,000 home loan, that would be the same as a 2.14% 30-year fixed rate mortgage. So although the interest rate on paper is 8%, and that freaks people out, the reality is the total interest paid, the TIP, which is what we focus on, the total interest paid ends up being the same as a 30-year fixed at 2.15%. So we like to help people see that and understand, hey, look, that the rate on paper is a factor, and we want to take it into consideration. However, what's the most important factor here? Is it the rate that's on paper? And are we going to focus or fixate on that? Or is the money that you're giving someone else, your hard-earned dollars that you're not keeping in your own pocket but sending to the bank, is that more important? Well, we think the dollars you give in the bank is more important, and I would love to help. I love helping people save a ton of money. And so we focus on this total interest paid as compared to the interest rate that's on the paper. So again, this is what we do with everyone, but that's a good example of people that we work with who, when it works, I mean, we're talking $100,000 and paying off your home, 18 years faster, that's a big life shift. And so those are the kind of outcomes that I love to be involved with. And so anyway, that's an example of how it can work.
And just to be clear, so rather than paying, what was it, 262,000 or something like that on that chart, you're
Mm-hmm.
saving
102, 103,000.
$203,000
Yep.
by using. You're still going to pay $100,000 in interest, right? But that pales in comparison to what you would pay if you had the
Right.
regular
So
mortgage.
it's kind of an opportunity cost situation where it's
Right,
like, you can give the bank 200,000 or you could choose to give the bank 100,000.
right.
I would choose to give the bank nothing, but that's not an option. So I would much rather give them 100,000 versus 200,000. And
Got it.
so that's really why we like to focus on that total interest paid as
Mhm.
compared to the rate that's on paper.
That's right, man. So, what are the biggest financial advantages of using this strategy in this market right now in 2025?
I think people are kind of scared right now
Mhm.
with um, uh, the feeling of instability,
Mhm.
um, and um, I think that this can help from that standpoint for a number of reasons. A, because if you do cash flow and it does work, you can have something that you can have control over instead of having this amortization schedule that really isn't built for your benefit, be
Mhm.
in control of your pay down. So I think that whenever people have the ability to have control over a facet of their life where other times things seem like they're out of control, can give you a semblance of peace, right? That's one. The liquidity piece is big too. And we usually talk about liquidity from an investment standpoint because you can leverage the equity in the home for cash flow producing assets or building wealth in a way
Mhm.
that you wouldn't necessarily be able to otherwise. But um, I don't necessarily lead with this, but it can provide a security blanket for people in times that are uncertain by having an available $100,000 in equity that is there, that you can um, feel secure. There was a point in my life where I didn't have any cushion, and I owed a bunch in credit card debt, and I was calling my friends asking if I can borrow money. I mean, it was tough, and I was married, and I just had a kid, and so there was a lot going on. And now I know that I have a first lien HELOC. Now that I have that, I know that I have a substantial amount of equity in the home, which serves as a cushion for me
Mhm.
that I can use if I want to. And I don't use that as an excuse to spend more money, but I do know that it's there. And so when things are uncertain for me, I know that it's there. And so it allows for me to sleep at night in a way that I wouldn't be able to otherwise, I think. So there are a number of reasons, but I think those two, control and then security, are two really big ones.
Yeah, man, and that circles right back to what we were discussing. Again, this is a common topic in the YouTube comments. People say, "Hey, but I can just have more control by paying my house off quicker." Yeah, but your money is locked up in the house.
Right.
You can't eat equity, right?
Right.
It goes back
Yep.
to that phrase. You can't eat equity. It makes sense to have a HELOC, first lien HELOC. For every dollar you put in, you can pull back out.
Yep.
You have liquidity at that point. That's the big difference. I don't think people are really registering that part of it, the important piece. So you can pay off your house quicker, but you also have the liquidity. That's where this
Exactly.
is the key part.
And you're right in that I have heard that a lot. People say, well, couldn't I just put everything into the mortgage?
Then you'll
And
be broke.
well, yeah, here's the thing. You can put everything into the mortgage. You can do the same thing with your mortgage. And if you have a lower rate with the mortgage, the math proves that it would be faster. That's true. There's no question about that. No one's denying that.
Mhm.
But what I like to then ask people who bring that to me is a scenario where I'll ask them, okay, let's just say your friend comes to you for financial advice, and they say, okay, I have this debt and I need to pay it off. So I want to take everything that I have and put it toward this debt, but it's a place that I can never get the money back out.
Mm-hmm.
And I ask them, would that be good financial advice for you to tell them to go ahead and do that? To put everything you have toward a place that you can't take back out? And usually the answer that I get is no, that would be really, really bad financial advice. And I would agree with that. So there are people that I've talked with before who it's really hard for them to get around the fact that they could simply put everything at the end of the month toward their mortgage. And if the rate's lower, it's better. And from a math standpoint, it checks out. But from a safety standpoint, from a feasibility standpoint, from a realistic standpoint, none of those check out from a closed-ended loan where the money is locked away. And that's the advantage here, is that liquidity piece, which is everything you put in here, you can take back out. And so it gives you the ability to safely leverage everything, which is just, it's what you do. So because you're leveraging everything, it essentially makes it so there's no faster way to pay off the house because everything is there.
That's right, man. So I know we've kind of touched on this a little bit, but just to reiterate the type of person this is for, who's the best candidate for a first lien HELOC?
Yeah. So if you make more than you spend, if you're disciplined with your finances,
Mm-hmm.
if you if you're consistent with that, right? Discipline. If you consider yourself a pretty financially disciplined person, and if you make more than you spend, this can be a really good fit. Mm-hmm. That's the quality. Because remember, the only thing that makes this work is this consistent surplus every month, is a consistent cash flow, the residual income consistently month over month. And so the types of people that have that are usually pretty disciplined with their finances. And so that's the key with this. And so that's why we run that calculator. That's why we ask the question, should someone get this, before we even breach the topic of can they get it? Because what we want to make sure of is that we are extremely confident that the people that are moving forward with this, with us, are extremely likely to succeed with it. And so those are the qualities that really line up with this. So this is something that rewards discipline in a way that I haven't seen other things reward, and it rewards that consistency in a way that's absolutely amazing. So really, that's the key quality. I would argue that it's probably easier to live below your means with a higher income.
Mm-hmm.
That's not necessary. You don't have to make $1 million, but there's a cost of living that's a reality. And if that's the amount of money that someone makes, and that's the cost of living, it's almost impossible to live below your means. And that's a challenge that a lot of people have. Yeah. And there's nothing wrong with that. I said that before, and I'll say it today. There's nothing wrong with that. But I just know when this particular strategy works, and it's all reliant on cash flow. So I would argue it's easier for higher income individuals, but that's not an absolutely necessary thing. There are some professions that we could probably think of that have a stereotype of a lot of income, but they spend all of it. And so again, like for someone who makes $250,000, but they spend $250,000, this won't work for them, just like it won't work for someone that makes 60 and spends 60. Mm-hmm. And so it really has to do with that additional income on top of expenses.
That's it, man. So what are some of the biggest misconceptions when it comes to first lien HELOCs?
Misconceptions. The one I run into the most is the rate, interest rate.
I can see that.
We are taught to look at the rate only and to determine whether loans are good or bad. And I'm fine with that. I get it. It makes sense because with an amortized mortgage, the rate is the only factor that you should look at. Mm-hmm. So everyone knows about traditional amortized mortgages. That's what we learn about. And our perception and understanding of home loans is based on that. So then we take that and apply it to other places. And that's fine, but people take that and they apply that here. Like the example we saw before, I was comparing an 8% rate on one vehicle to a 4.5% rate on another vehicle. And the 8% interest rate vehicle, we'll call it, resulted in a $100,000 savings. Well, how is that? Well, it's because of the amount of time you're paying interest. The time matters. But with an amortized mortgage, the time is set. So we don't analyze that. And the balance you're paying interest on matters. But with the amortization schedule, the balance is set by the schedule. So we don't analyze it. So no one takes into account the amount of time you're paying interest or the balance you're paying interest on. Well, those are the things that we focus on. I don't worry about the rate. I focus on how fast you're going to pay off the house. And we focus on what's your balance look like. And so, and how quickly can we get you to a low balance so that way the rate doesn't matter anymore. Mm-hmm. There's the where is the rate right now, and then there's the fact that it's variable too. That first is 30-year fixed rate mortgages. If it's a variable rate product, it is really bad because if the rate goes up a little bit, it costs a whole lot of money on the back end. Well, with a first lien HELOC, just like the starting rate can be higher, if the rate goes up and down with a first lien HELOC that you're paying off really quickly, it doesn't really change the outcome that much. So because it doesn't change the outcome, to me, it just doesn't belong at the top of the totem pole in terms of importance. It belongs on the totem pole. We need to talk about and understand what the outcome is. But if the interest rate increases by 2 points and it doesn't really change the outcome to much of a meaningful effect, then that means the fact that it's variable doesn't really mean that much here. And that's one thing that we try and help people see and understand, which is that what we know about mortgages is correct, but it's rooted in an amortized structure. Well, the assumptions that we make about a mortgage are correct with that kind of home loan. Mm-hmm. Reality is this just isn't that. So we can't make those assumptions here. What we can know is that we don't know how the rate affects it. So what we have to do is then understand with my cash flow, with my balance, with my payoff time, what is the effect of the interest rate and what's the effect of the interest rate changing? And that's what we spend a lot of time helping people understand and see is, okay, if the rate changes by 3 points, it doesn't really do much. How much do we really need to worry about the rate? And how much do we need to focus on that? And so you have varying degrees of people who focus or fixate on that interest rate. So part of what we try and do is help people strip those assumptions about the interest rate from their understanding to see this for what it is. So yeah, really the rate is the main misconception that I'll see here.
Got it. Now there's risk in everything. I'm sure you'd agree with that. But yep. What are some of the real risks that people they should at least keep an eye out for before they switch to a first lien HELOC?
So this reminds me of a story. Our calls usually last about an hour with people. We ask about their goals and then help them understand the strategy, help them fill in gaps. We run the calculator and then we explain our product and help them get started with that. 2/3 the way through conversation, I told the guy, I said, okay, so, and I use this example knowing that it's not a good thing. So I say, this is right when those new Ford Broncos came out. I was like, you could use your equity in the house to buy a new Bronco. And this guy was like, sweet. And I just thought to myself, I was like, oh no. I was like, this is the wrong, how did we get this far through the conversation and me not realize that this is not the right mindset for this. Yeah. And so then I was like, okay, I'm gonna have to spend the next 20 minutes convincing him not to get this now, because that's an extreme example. And I never
that too, by the way, man. That was
and I never expected. I used to use Lambo, and then I kind of came down to the Bronco. And when I said Bronco, he's like, sweet. And I was like, oh no, like that if you can't afford it right now, like you don't want to use your home's equity to buy it. Like this is the wrong thing. But that being said, that's an extreme example of the risk. A more realistic one, though, Jamel, is someone. Let's just say, and I'll use these numbers. So you bring in 10,000 and you're spending 8, right? Overall, including the interest for the HELOC. So you're paying the loan down by 2,000 a month, and that's oversimplified math. Just for anyone that would like to call me on that, it's oversimplified. But for the sake of understanding this, I want to oversimplify the numbers. And then one month they, instead of spending 8, they spend 9, and they still paid down their house by 1,000. But no one calls them, and there's no red slip that you get from the bank, and there's no hand slap. Mm-hmm. So if that person doesn't realize that they spent more than they did last month, and instead of paying their house down by 2,000, they paid it down by 1,000. It would be easy for that person to get in the habit of spending 9,000 every month. So now instead of paying down their home by 2,000 a month, they're paying it down by 1,000, which isn't the end of the world, mm-hmm. but it's doubling your payoff time, right? And then 8 months down the road, they bring in 10,000, they spend 10,000. So now the balance goes down by 10, and then their expenses are 10, which brings it right back to where it was. Well, if they don't notice that, no one's calling. Again, no one's calling. There's no consequence. No, the bank's not calling and say, hey, you didn't pay your home down. Right. If you don't notice it, then it would be very easy for that person to get into the habit of spending everything that they make. Well, let's just say they spend 11,000 one month and they don't notice. And now they spend 12,000 a month and they're bringing in 10. Well, down by 10, up by 12 means you now owe more money on your house than you did the month before.
Right.
That's the risk. And that's the thing about what we're trying to do, which is find people who are disciplined, because we believe that one of the hardest things to change are people's habits, yep. Their routines, right? And there are people that make a very, very good livelihood on helping people change their financial habits. Mm-hmm. And they do improve people's lives like crazy. And I love that. That's not the job that I've taken on. That's not what we do, right? I can help provide perspective about budgets, but if someone's budget doesn't align with what this product needs for the product to be successful for them, to be of benefit to them, mm-hmm. That's why we tell them it's probably not a good fit, because habits are extremely hard to change. And so if someone overspends or has the tendency to not be disciplined with their finances, that habit, unless they have someone else to help them overcome and change that habit, is likely to continue. I liken it to new diets or new exercise routines, or waking up early in the morning, that kind of thing. A lot of times people get excited about it. They do it for a certain period of time, but it doesn't last. Mm-hmm. And so that's just sort of human nature. And so people who are disciplined and who already do live that way, and that's their lifestyle, we also believe that lifestyle is not likely to change either. And so if someone already is disciplined, I don't believe it's likely that they're going to change that just because they get a first lien HELOC and all of a sudden ruin themselves. That doesn't make sense to me. In the same way that if someone gets a first lien HELOC, they're not all of a sudden going to cut out all their expenses and eat beans and rice, right? Yeah. They're not going to change their lifestyle because they get a first lien HELOC. So that goes both ways. If someone's really disciplined, or if someone makes more than they spend, that's not going to go away because they get a first lien HELOC, which to me tells me, okay, that person's likely to succeed. And so go win. So that is, that's the kind of approach that we have. regarding that piece to it.
Now, a lot of people, everybody makes mistakes, right? What type of mistakes, and you've been doing this for a while, what type of mistakes have you seen people make trying to use the first lien HELOC?
Well, luckily, I didn't see someone buy a Bronco with it. I did not see that happen. I could have seen it, but I didn't. Um, you know, I've seen people overspend. I've seen people forget. I've seen people use it like a glorified credit card um, to fund to fund things in their lifestyle
Mm-hmm.
that maybe they wouldn't have
Mm-hmm.
because they lose. I think it's because they lose focus or they forget or they're not paying attention. Um, the um, those are the I mean those are the main ones because that's what if we're talking about using it incorrectly, that's the way to use it incorrectly. There isn't another. I was on the phone with a lady earlier today, um, and she called. She wanted a higher line amount on her house, and she started at about 160, and now she owes 230.
Mm-hmm.
And she was calling to get a higher line. And my initial reaction was, your behavior or your spending behavior, your budget behavior is one that doesn't align with this. So it doesn't make sense to give you a higher line because in 3 years you could owe another 80 grand.
Mm-hmm.
Well, come to find out, over the past 3 years, she lost her job
Mm.
for 6 months. And the job that she got provided $40,000 less than what she was making when she initially got the first lien HELOC. So the first lien HELOC, what it did is it allowed for her to function through that tough period of her life. And now she's back to the income level that she made before. Her timeline's pushed back, but she's back on track and she's knocking down her principal balance again. During that time, I also learned that she got sick and had a $40,000
Mm.
medical bill. Well, the first lien HELOC helped her weather that too. Now, I don't lead with this, it can help you out of a tough situation, because if that's what people are worried about, this can't be the fix for that. It
Right.
can't be. But that's an auxiliary benefit on top of the others, which is it helps her do that. At the end of the conversation, when I learned what the past 3 years for her looked like, from a financial standpoint, I realized that her position, the fact that she owes more on her first lien HELOC than when we first gave it to her, isn't a result of her behavior. It's not a result of her spending more money than what she made back then. It's three pretty extreme one-off situations that happened, and now she's back. And at the end of the conversation, I told her I would feel confident if you wanted to move forward with this, where at the beginning of the conversation I wasn't. And so I know that that's kind of counter to how would I see people making mistakes,
Mm-hmm.
but those are the kind of conversations we have with people to try and understand what is what do your habits look like? What's your budget look like? You know, A, do you make more than you spend? And B, is that likely to continue, if it makes sense? So, yeah.
Got it, man. Now, how can someone protect themselves against rising interest rates when using first lien HELOCs?
Well, it's pretty simple. They either pay down their balance really quickly, or they pay off their home,
Mm.
or they pay it off. Um, if I've got a balance of $500,000,
Mm-hmm.
rising interest rates are going to affect me pretty drastically compared to if I owe 50,000
Right.
or 100,000. Right? If a rate goes up by 2 points and I owe 50,000 on the house, it doesn't really change my payment much. If we're
Mm-hmm.
talking about an interest only loan, um, if if I pay the house off in a year and a half or 5 years compared to 26, rising interest rates don't really have the
Mm-hmm.
ability to affect me because the period of time is so short. So, um, for people that are looking into buying new houses or refinancing at this point in time, a lot of times they're facing pretty high interest rates, which for the long run are going to cost a whole lot more from an overall standpoint. Although the rate on the first lien HELOC is higher than 7.5 or 7.25, wherever 30-year fixed rate, interest rates are right now, by having the ability to pay down the home really quickly, to arrive at a low balance quickly, or to pay it off in a short period of time, allows for you to essentially mitigate the effects of the rising interest rates because you're controlling the other two factors that matter, which
Right.
are balance and time.
Cool, man. So let's talk about some of the experiences.
Yeah.
Do you know of anyone who successfully replaced their mortgage with a first lien HELOC?
Oh, yeah. I think 14%. So we've probably in the past 5 years, we've helped over 1,600 families get into a
Wow.
first lien HELOC, and 14% of those have fully paid off their homes.
In
So
5 years.
yeah, our average pay down per year is right around $35,000 per year. Um, so compared to, I mean, I think an amortized mortgage average pay down,
You got me pulling out my calculator, man. You
yeah.
said,
Let's see.
I mean,
Um,
so that's 200 and out of 1,600 people, you're talking about 224, 225 people paid off their mortgage already.
yeah, yeah,
Wow, man.
for real.
Incredible.
So yeah, we have. I mean, it's really amazing the stories that we've got. I've been able to do some interviews and testimonials with a few of them, and it's just so cool, the excitement that they have about it, and the passion that they have for this tool, whether they've fully paid it off or whether they've paid it down a lot,
Hmm.
is really, it's not hard for me to get people who are our clients
Right.
to want to talk about it, because that's what happens. They just get so excited and they just want to share. So a lot of it's just kind of asking them questions like you're asking me for them to share their experience. So absolutely, yes.
So have you ever had a situation where it didn't work out for somebody?
Yeah, yep. And again, it's for the same kind of reasons we talked
Hmm.
about
Yep.
before. When they forget about how it works, or they choose to spend more. Um, let's see. I think out of all of those loans, I think we've only had one default,
Mm.
um,
Wow.
which actually turned out to be kind of a little bit more than just like more so almost fraud kind of thing. But so out of everyone, only one person has actually failed, we'll call it.
Got it.
And it was someone who didn't use it at all the right way. They never deposited their income. All they did was use the line, again, like a glorified credit card.
Mm.
And so for people, when they use the strategy, um, it works like most of the time. It's really crazy. When people are increasing their balance, I know I said the bank doesn't call, and they don't slap your hand, but we do have a couple people who call sort of as customer
Hmm.
service reps to help people when
Courtesy.
their balances are
Yeah.
continually increasing,
Hmm.
because of overspending, just to provide a little guidance, some accountability as well, and help them understand what that means.
Hmm.
I had a conversation with someone, and I called them, and they were a previous client of mine. I said, "Hey, your balance is increasing by $2,000 a month, and you've got 20 grand left in your available line." And he said, "Yeah, I know. I'm trying to get it under wraps." And I said, "You realize that what that means is if you continue with that, you're gonna you're gonna run out of money, and you're talking 30, 60, 90 day late, and then the bank would file."
Hmm.
And that clicked with him. And he said, "Oh, okay." thank you for telling me that, because now I know what I have to do. And he turned it around. And again, not everyone that's, it's not like Anthony's this like, magic, discipline maker person. That scenario was one that worked. But again, you see people whose balances are increasing. And at some point, if it doesn't work, before it turns into the worst case scenario, we'll just say, hey, look, it looks like this is, if this is a lifestyle thing and you're not investing in cash flow producing assets,
You really help them.
we try to, yeah, we really do. And we help them, merge into something else if this isn't a good fit for them. And so, so we try and identify that sooner than later. Not before it's too late, but just because we're here to help people. And if this is proving to be something that isn't providing benefit, or they're using it in a way that doesn't align with their financial best interest, then we want to name that. We want to help, with alternatives as well.
Good stuff, man. So if someone listening right now, if they're interested in getting a first lien HELOC, what should be their first step?
So you're going to want to take a look at your credit score, right? You're going to want to have above a 680, really 700 though. So if you're not there, that's going to be kind of step one. That's kind of a baseline. So 700 credit score. I need to, we can go to 90% loan to value. So you want to have 10% equity in the house. So for instance, if the home is worth $400,000, you want to have paid down the balance by 40 grand. So you want to owe 360 on the house, because that way we can get the loan. We can do it when you owe more than that, but you have to bring cash to the table, which may or may not be worth it. But all in all, you want to have at least 10% equity in the home. Let's see. I mean, you want to make more than you spend. So from a qualification standpoint, that's kind of what you're going to want to look for. We can't do manufactured, mobile, or modular homes. And we can do all states except for Texas, Maryland, Hawaii, Alaska, and New York. So yeah, and then so that, take a look at your budget, think about your current practice, and if you think if you would identify as like being pretty disciplined or good from that standpoint, I definitely think it would be worth looking into.
Now, what qualifying questions should someone have in mind when they're doing an interview with you, for example?
Yeah. So we had a couple of those just now. Let's see. For those who pay attention to or who are aware of loan jargon, we want to I can go to a 45% debt to income, which means that all of the liabilities added to the projected payment for the first lien HELOC can only be 45% of the qualifying income that we use. I don't usually put too much credence into that, because there are different ways of calculating the debt side of things. So the way that we stress the loan is important to know. Do you include escrows, that kind of thing? But we can go to 45% debt to income. We need to be able to show 5% reserves of the mortgage. So if it's we'll do 400,000. If it's a $400,000 home loan, we need to show $20,000 in reserves somewhere. So that can be a combination of different places. It can be your, obviously checking or savings. We can use the vested amount that people have in their IRAs or 401ks if you can, get a hardship loan with that. Liquid investment accounts as well. I can't use like crypto, but we can move money from crypto for the time being to a checking to use it that way. So 5% reserves. Right now, I can only do primary residence properties. One thing that I would suggest is, a lot of times when I say that, the investor-minded and the real estate investors tend to say, "Oh, I wanted it for an investment property only." And my question to them a lot of times is, would you consider it for a primary? Because you can accomplish the same thing with it on a primary or with it on an investment property as well. And so the benefit that you get from it can be received as well on a primary too. So I like to sort of ask that question just to keep the conversation going. And a lot of times, once we walk through the different ways to use this financial vehicle, people who initially just wanted it for an investment property end up getting it on their primary as well, or their primary first, because the benefit that they can bring is that great that it's just a matter of having a conversation and aligning it with what people are trying to accomplish.
Got it, man. Now,
Yeah.
I know we keep bringing this up, but this is super important. How much discipline does somebody really need in order to make this work?
So we teach this strategy in a vacuum, in that you have to be really disciplined, right? And you have to make more than you spend every month, or this. And the way I teach it, I think, has someone assuming that it has to be perfect or it's terrible. Meaning we have to be perfectly disciplined or it's a bad idea, or we have to be absolutely to the T, making a lot more every single month than we do. Well, this loan, it's a flexible it's a flexible loan.
Mm-hmm.
The key here is liquidity. And so the liquidity is something that allows for this to be accomplished in a way that's safe. And so
Mm-hmm.
you need to be disciplined in the fact that you need to make more than you spend, but it doesn't have to be a penny pincher. If this doesn't work perfectly for me this month, then I'm screwed. That's not the reality. The reality is that just like our lives are fluid, this loan is fluid. I have, realtors, for instance, who will make $30,000, $60,000 a month sometimes, but then they'll have a dry spell where they make two or zero. And their reaction is, oh, for those months, I don't make any money, so it's not a good idea for me. Well, my response is it's actually the opposite of that. This provides stability for you in the months that you're not making anything, because in that scenario, you drive down your income by 90, you drive down the balance by 90 grand, and then you use it to pay your bills for 3 months until you get another good month. And
Mm-hmm.
so all in all, over that year or over that whole time span, you just need to make more money than you spend. So it isn't necessarily the exact penny pincher person, right? It'll be great for that person, but it also is, for people who have variable incomes where it's, decent one month and small the next month, this can provide a level of security that you just don't have with a mortgage, because your mortgage payment is always the same. And so on the slower months, we call it floating the debt. You just pull from the debt. Yeah, it increases your HELOC's balance. That's true. That happens. But all in all, this idea that it's detrimental to the loan itself just is that isn't true.
Right. Got it.
Does that help?
It absolutely does, man. I think that's definitely going to provide some clarity for people as well. So, how can using the first lien HELOC tie into large or larger wealth building strategies? Say, for example, real estate investing.
Yeah.
People on my channel, we focus on real estate a lot
Yep.
for generating wealth, right? But how can using this HELOC, this is a strategy, I know the answer to this already, but for people who don't know what a HELOC is or
Yeah.
how to use it, this is a strategy we can go into a lot of details on following videos. If you guys want to see that, by the way, be sure to leave a comment in the comment section. Just say, hey, talk about HELOCs and real estate, HELOCs and entrepreneurship. Leave a comment in the comment section. Anthony and I are considering creating more content wrapped around those particular topics anyway.
Yeah.
But
Yeah.
how would that all tie in?
So far, we've talked about the debt reduction capabilities of
Mm-hmm.
this and the interest savings capabilities of this, and that aligns with a certain type of goal that people have. There's this, I love it. Think of it like it's like the traditional American dream, where we're going to pay off our house, we're going to become debt free, and then live in perpetuity in happiness, which I love that. And this can help people accomplish that.
Mm-hmm.
There's another type of goal as well, which has to do with building.
Right.
And to build, you have to leverage something. And so if we think about this debt reduction piece, as you pay down the balance, so you have that $300,000 HELOC and you're paid down the balance. We talked about that $200,000 before, that example where you paid off the mortgage. I think it was at the beginning of this video where you pay off the mortgage, you have a $300,000 limit, first lien HELOC, and your balance is $200,000 because that's what your mortgage balance was initially. And at that point in time, you would have $100,000 available to you to use as you wish. Hopefully, again, not buying a Bronco, but you could at that point in time, you could leverage that if you wanted. Let's say you pay that $200,000 down to $100,000. Well, remember, every dollar you put in here, you can access as well. So that $100,000 that you used to pay down the balance of your loan, right? You still have access to. So now your balance is 100, but you have access from that 100 balance up to your $300,000 limit, which means now you have access to $200,000 in your home's capital. Today, this isn't a week from now. This isn't 30 days from now like a regular cash out refinance would be. It's not 10 days from now or 5 days or 6 days if you have good relationships with hard money lenders. This is today, around 8%. So now the script is flipped a little bit, where borrowing $100,000 at 8% today is cheap money compared to accessing that amount of money in that period of time right now, right? And so now you're borrowing money at a rate that's better than essentially a cash out refinance, maybe, which takes 30 days. It is cheaper than hard money than what I'm aware of. And it's cheaper than, there's a company that will lend you money today, but it's like amortized over 5 years at 18%. So anyway, it gives you access to an amount of capital that it's worth it to invest. So that's one example. Another one is if you simply just are sitting in a good equity position in your house right now. Mm-hmm. If they have a $400,000 home loan and if they have a $400,000 valued house, so the home's valued at $400,000, but they owe $150 on the house, right? Well, I can go to $360. So what that would mean is, they owe $150 and they can focus on paying that down, but right away, they would have access to $210,000 right now. What would that do for you, Jamel, if you had an additional $210,000?
Man, I'm turning that into a couple million.
Right? And so now, as you invest, people build up capital. But if you're first starting out, or if you just got started and you have one deal and all your cash is out in the market, well, having an additional $200,000 at your disposal could allow for you to do two deals at one time instead of one, right? So now you're doubling the compounded, effect. So it essentially gives you access to capital that you don't already have access to, in a way. And there was one guy that we work with. He says the money shouldn't be stuck in the 2x4s. Don't let your dollars be stuck in the 2x4s. And what he means by that is, with an amortized mortgage, you can't take the money out. So you can pay it down you can pay down the balance down all you want. Mm-hmm. But really all you have at that point is equity that you can brag about to your neighbors instead of use and leverage. And so his whole idea is take the money out of the 2x4s and leverage it for cash flow producing assets that can build wealth for you, but also create more cash flow. So, and we can, if people are interested, we can talk more about that as well, to run scenarios to see what that could look like. But whether it's a flip where you borrow and, You borrow to buy the home, you do your own renovation, you sell, and then you put the principal back in the HELOC and the profit back on the HELOC to pay it down, and then rinse and repeat. Or if it's a buy and hold, if you do the burst strategy, which I don't know why I'm the one talking about this because this is your place. But if you buy the house in a way where there's enough equity at the end from an ARV standpoint for you to get all the money back out, then you just dump the money back in the first lien HELOC for the next deal. And so when you
There's got
dump
to
the
be
money
some
back,
tax benefits to that as well, man. So
there are tax benefits. And so, from the real estate side, but first lien HELOCs also send out a 1099-R.
yeah,
So it's unlike a second lien HELOC, a first lien HELOC, because it's in the first lien position, um, you get to count it as mortgage interest as well. So you get to write that off too.
that's right, man. This has been a great call, man. I got a
Yeah.
couple more
Thank you.
questions for you, but
Yep.
I wanted to take a minute to really go through some rapid fire questions before we close out.
Okay.
Um, these are really designed for really short answers, like one word answers, so to
Yep.
speak. So
Okay.
let's see what we got here. Fixed rate or variable?
Variable.
Variable. Why?
Uh, Half the time variable goes up and half the time it goes down. So 50% of the time a variable interest rate product's going up and 50% it's going down. I think rates are inflated right now, so I think they're going to come down.
So it'll be more balanced with a variable, pretty much, right?
Yep. I think so.
Got it. HELOC with a local bank or a national lender?
HELOC with First Savings Bank in
There
Indiana
you
because
go,
it's
man. That's the
mine.
right answer. That's the right answer. Good credit needed.
Yes.
Got
Good
it.
credit needed.
First lien HELOC or refinance debt? Refinance
First,
first, I should say.
if you make more than you spend, you live below your means. First lien HELOC all day long.
Got it, man. Now, best use of equity: pay down fast or reinvest.
Whatever aligns with your goals the best.
I love that answer, man, because everybody's goals are different, right?
They
Some
are.
of us
Yeah.
need to pay off debt before we start thinking about investing,
Yep.
right? Some of us
Oh,
want to.
pause. Pause for a second. Pause for a second.
What you got?
I misunderstood the question. Um, pay
So
off.
let me
Do
ask
that one
you
again. Do
again.
that one again. Yeah.
Ready? Best use of equity: pay down fast or reinvest. I know what I would do, and I'm going to provide that answer after.
Okay. If it's high interest consumer debt, pay down debt first.
Yeah,
Always.
yeah.
Get rid of get a good baseline before you leverage. So take care of debt first. When it comes to consumer debt, um, then if you want to invest, then invest.
I love that answer, man. Um, I guess what I would pay down high interest debt first as well, but there's a portion of people who might want to invest it into cash flow and assets to help pay down that high interest debt.
I agree. I agree. So it gets a little deeper than that, I think,
That's what I mean.
because here's the thing. There are a couple of things to it. One is what's the reason for the debt? Is it
Yeah,
because we bought a bunch of stuff that we shouldn't have bought, right? And there's a route. Then it's like get rid of the debt and then fix the problem and then
right,
leverage.
right.
But if it's there because they're already investments, right? Then leverage all day long, right? And does that make sense?
No, it does, man. And if it were me, honestly, and I've got experience with this, so that's why I'm going to speak on it. If it were me, I'm paying down the debt because then I'll have more cash flow later on,
Yep.
right?
Yep.
From the investments. I don't like a lot of bad debt. Now, if we're
Agreed.
talking about mortgage debt that's actually making me money, I'll take on $1 billion. I don't care.
Yep.
But if we're talking about $1 billion of debt that's coming out of my pocket, I don't want that.
Right. Right.
So if it were me being smart about this and realizing we're talking to, people who are probably not as savvy in investing as we are, I'm going to pay down the debt first and then start considering investing the money. Now, if
Agreed.
I pull out a HELOC, for example, and I got a certain amount of debt, a portion of that's going to go off to paying off the debt. The rest of it, I'm not touching it
Yep.
until I find the right investment strategy.
Yep.
To me, that's the best use of it.
Yeah, agreed.
Right?
Definitely.
So that's just my 2 cents with that. But you guys, matter of fact, leave a comment. Let's start a conversation wrapped around that too.
I love that.
One, I'd like to hear if you guys want to hear, if you want us to provide more detail on how you can use these HELOCs for investment strategies and entrepreneurship. Leave a comment in the comment section. But also, if you had debt and you had an investment opportunity, what would you guys do with the money if you had
It's feeling.
access to it? Let's start a conversation wrapped around that. I'd love to create more content around that and see how we can further benefit you guys with this as well. Good stuff, man. Couple questions before we wrap up, man. Who should absolutely consider a first lien HELOC in 2025, and who should stay away from him? Now,
That,
keep in mind, we got all different types of issues,
mm-hmm.
right? We got conflicts with other countries. We got political issues, things like that. I'm not here to talk about politics, but um, if we had to consider everything, we got people losing their jobs, government workers. We had to consider everything that's going on in the state of the economy right now. Who would be the perfect fit? Who should consider a first lien HELOC? Who should stay away?
So, so if you're someone who wants to pay off your home quickly,
Mm.
if you are committed to that, if you are frustrated with the amortization schedule,
Hmm.
if you're disciplined with your finances, so here's the thing: we can pay off debt with a first lien HELOC, and
Mhm.
we've been able to do it in a way where it increases people's cash flow to where this works really well or works even
Mhm.
better, because cash flow is the name of the game. If the debt is there for a one-time or one-off event or extreme different circumstances, but you're disciplined with your finances, and we can clear up that monthly payment, that cash flow, so you cash flow to make this work, this can be great. So if your position is one that you do have consumer debt that's eating up your cash flow, if the reason for the additional debt's there, then if the reason is from some external circumstance aside from just spending habits, then we can wipe that away with the first lien HELOC and make this work for you. So it
Mhm.
really, if you make more than you spend, or if you're disciplined with your finances, you really, I like to avoid saying the word should, but I really think you should learn about this as much as you possibly can, and you should consider it because it's extremely powerful for the right person. It's absolutely amazing.
And also keep in mind, if you got a 680 credit score, let's just say, and you have some debt, you pay off that debt with the HELOC, your credit score shoots right back up.
Mhm.
You know what I mean? So you have, I mean, there's a lot of different opportunities with this thing, man. I can't even. I mean, there's so much to talk about in an hour and a half that
Yeah,
we can cover, but you guys
absolutely.
kind of get the point. So if someone waits another year or two, say that they're on the sidelines and they're on the fence right now, they're considering it, but they're not 100% sure. Could they miss the opportunities? What type of opportunities could they miss over the next year or two?
So I I, I like this question.
Me too.
I My answer is going so I've never met a realtor who's ever said this isn't the right time to buy, right? And whether it's a great market or low market, it's always the right time. It's always the right time, right? Um, and that was going to be my quick response, but the number one thing that I hear from people is, Anthony, I wish I would have learned about this 5 years ago,
Mm,
right?
mm,
Our first lien HELOCs can still be around in 2 years, 3 years. Yeah, I mean it's a mortgage product. Um, um, will I still be around? Yeah, I mean I hope so, but yeah, I'll still have them. But what people will miss out on is the opportunity benefit,
mm,
right, of paying down your mortgage for, let's say like rates skyrocket, and in 2 years this wouldn't be a good idea, right?
Mm-hmm.
Which goes against the whole rate thing. But what you lose is that 2 years of driving down your balance like crazy, right? And now
And you
you're in a
said the
much better
average
equity
payoff is
position.
35,000 a year, so you're talking about 70,000. That's
70 grand. If you're
$70,000.
the average, right? 70 grand of payoff compared to 10 with your amortized mortgage. That's what you'd miss out on. And so, is that the end of the world? No, but that's a whole lot of money to give the bank instead of pay down your mortgage so you don't have to give them, right? And let's say in 2 years, an amortized mortgage, which again, this kind of goes against the whole. I love to bash the amortized mortgage, but let's say in 2 years that makes more sense. I would much rather refinance into an amortized mortgage with a $70,000 less balance instead of a $10,000 lower balance.
Mm-hmm.
And so, if it's going to work with someone's cash flow, it is, and it's going to work now. So, what I would say is that if you hold off or don't look into it or wait, what you're doing is you're agreeing to a much worse path for 2 years or a year or 3 years than a better path. That doesn't make sense to me. So you'd be missing out on that. I mean, if it works, it works, and it works quick. And what people do when they learn about this is they regret the fact that they didn't hear about this 10 years ago. Because
Mm-hmm.
what they say is, Anthony, I paid down my mortgage not by a third in 10 years, but I paid down my mortgage by I don't know, like 1/10 over the first 10 years of their 30-year fixed. Instead of paying it down by a tenth, they say, Anthony, I'd have paid this off by now. And what I tell them is, aren't you just grateful you found out about it now? They say, yes, I am. Let's get started. So, so when it works, it's just a better option. So, like realtors say, right now is always the best time to buy. When this works, the reality is this is the best option for you now. And if it doesn't work, then it isn't the best option for you now. So why would you choose an option that isn't as good for you than one that is, than one's
That's
better?
right. Absolutely. And as you've already alluded to this, man, in real estate, there is a phrase: the best time to buy was yesterday. The next best time to buy is today.
That's right. That's right.
Right? Same thing in HELOCs.
Yep.
The best
Yep.
time was yesterday. The next
Yep.
best time is today. There is always an opportunity. If you have access to the resources, which a HELOC is a resource, to
Yep.
take advantage of an opportunity, right? Why not get yourself in a position to be able to take advantage of these opportunities that come along over the next year or two, rather than sitting on the sidelines waiting? So right now is the best time. Yesterday was even better, but today is the best time. And I
Mm-hmm.
understand the economy. I understand everything that's going on right now. People are scared. People want a surety. But guess what? This is just another market cycle. It really is.
Yep.
Right. So I've been investing in I've been in the real estate industry since 2002. This is probably my fifth market cycle. Every single one of them was a doom and gloom. Every single one. Right? People, oh, the market is going to crash. The market is going to do this. The market is going to do that. You know what works the best, and what worked for me over the years? In stocks, they call it dollar cost averaging, right? So you buy whether the market is bad, you buy when the market is good. But at the end of the day, you're always going to be balanced,
Yep.
right? So obviously you'll get better deals when the market goes down,
Yep.
like a market like this. Higher interest rates, high prices of homes creates more creative finance opportunities, right? But then you also have the good market where fixing and flipping may be a good opportunity. You can still get cheap homes, but now you can get top dollar for them. The point is, whether the market is good, the market is bad, it's always a good time to buy. And when it comes to HELOCs, it's always a good time to have access to the capital and to be paying down your mortgage a lot quicker. So with that in mind, how can our listeners get in contact with you if they wanted to? Now, I'm going to leave a few links in the description box below,
Yep.
but where else should they go
So
in order
if
to get some information?
if you go to firstlienheloc.com, there that's a really good resource to learn about that. And Jamel is going to put a link for you to book with the loan officers on my team. I'm the sales manager, and I've right now 3 loan officers who solely focus on first lien HELOCs. And what that link will do is it'll ask you for some information, and then you'll book a call with one of them. Just so you know, all they do is first lien HELOCs. I was the first originator here, and the model that I built is the one that they implement. And they're actually probably better than me at this point since they have a lot more at bats recently with it. But there'll be a link to book with the team. Another thing to do is if you want to check your numbers quickly, is if you go to firstlienheloc.com/calculator, it'll kind of run your numbers for you and let you know, are you with those numbers, with that budget, with that balance, is this likely to be a good fit? Or what would the outcome look like, to help you get a good gauge for that too. That's probably a good first step before you book the call. So I would say first check that out. Again, firstlienheloc.com/calculator. And then the link to book a call with our team, Jamel, I think you said you're going to put that down below, right? It's a little bit more involved than just me kind of saying it right now, but that'll be below for you to book a call with my team. And again, they'll go through 4 steps. What are your goals? What are you trying to accomplish? They'll help answer any questions you have about the strategy, fill in any gaps that you may have in terms of that, address any worries. They'll run your numbers with a calculator also, and then talk about the product to make sure it'll be a good fit for you.
Awesome. Anthony Rushing, ladies and gentlemen. Be sure to check all the links in the description box below. Be sure to really consider First Lien HELOC for your own personal resources, your own personal references as well. Learn as much as you can about this particular investment strategy. I have an entire playlist on HELOCs and infinite banking and all of that stuff as well. Be sure to check that out. As a matter of fact, I'm going to link it for you so that you'll have access to it. Share this video with as many people as possible. I think that anybody who owns a home and they're truly considering paying off their house as quickly as possible, they can put themselves in a position to be able to take advantage of something like this. And it can literally change the trajectory of your entire future for you, for your family, for anybody you know, right? So truly consider this. This is something that, obviously I keep bringing Anthony on, is because I understand the power of this strategy. And you guys have answers as you leave more comments on my comments section on YouTube or any other place where you're leaving comments. I'm going to create more content wrapped around that to clarify things for you, because I want you to be really clear on how this works so that you can implement it into your life. So leave a comment in the comment section if you have any questions. Like this video, subscribe to the channel, click the notification bell. This has been the Deal Pro Podcast. I'll see you guys on the next one. Take care.